All right, if you've ever even glanced at a company's financial report, you've probably seen this acronym, EBITDA. It looks a little technical, maybe a bit intimidating, but it's actually one of the best tools out there for understanding what's really going on inside a business. So today, we're going to pull it apart and see what it truly tells us. So let's kick things off with a really basic question. When you look at a company's profit, that final number at the very bottom of the page, is that the whole story? Does it tell you everything you need to know?
Well, the short answer is not really. That final profit number can be kind of misleading because it's affected by all sorts of things that have nothing to do with how good the business is at its core. And that's exactly where EBITDA comes in. It gives us a different and often much clearer angle.
Okay, so let's get right into it. To really get why this matters, we have to break down what this thing actually is. Let's decode the acronym.
So, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Yeah, I know, it's a total mouthful. But the big idea behind it is actually super simple. It's just trying to figure out how much profit a company makes from its main day-to-day business operations. That's it. The easiest way to think about it is that EBITDA cleans up the profit number. It's like putting a filter on the company's earnings to strip out some of the financial noise that can get in the way. And here are the four main things it filters out. First, you've got interest. That's a financing decision, right? It's about debt, not operations. Then taxes. That just depends on the government and tax laws, not how well the company is run. And finally, depreciation and amortization. These are just accounting rules about how assets lose value over time. No actual cash is leaving the building. So by taking all that stuff out, you get a much purer look at the business itself.
All right, theory's one thing, but seeing it in action, that's where it really clicks. So let's crunch some numbers with a super simple example to see how this works.
Okay, so check out this imaginary company. They made $10,000 in revenue. But after you subtract all their costs, their interests, their taxes, the final profit, the number that gets all the headlines, is only $1,800.
Now, to get our EBITDA, we're going to do that cleaning process, but in reverse. It's really easy. We just start with that final profit of $1,800, and then we simply add back the interest, add back the taxes, and add back that depreciation figure. And boom! There you have it. You get $3,000. Just look at that. It's a completely different number than the $1,800 profit we started with.
And this slide, right here, this shows you everything. The company's final reported profit was $180,000, but its core business, its actual operational engine, generated 3,000 times before all that other stuff, like financing and accounting rules, came into play. That's a huge difference.
Okay, so that's the what and the how. But here's the real question. Why should you even care about this number? Why do investors and analysts get so obsessed with it?
Well, a healthy EBITDA is a really great sign. It's often used as a rough proxy for how much cash the core business is generating. It helps you see how efficient the operations are. And most importantly, it tells you that, at its very heart, the business is strong and profitable.
And here is EBITDA's secret weapon. It's amazing for making comparisons. It really levels the playing field. If you have one company that's loaded with debt and another that has none, their final profits will look totally different. EBITDA strips that away so you can compare their operations, apple to apple.
But, and this is a huge but, you have to be really, really careful. EBITDA is a fantastic tool, but it is not the whole story. Not even close. It has some massive blind spots that you absolutely have to know about.
This quote right here just says it all. A company can have a sky-high EBITDA, look amazing on paper, and still be on the verge of going bankrupt because it doesn't have enough actual cash in the bank to pay its bills.
And here's why. EBITDA completely ignores some very real expenses that drain cash. You have to pay the interest on your loans. The government is definitely going to come for its tax money. And if you're a manufacturing company, you have to buy new machines eventually. All of that costs cold, hard cash, and EBITDA basically just pretends none of it exists.
So what's the bottom line here? It's all about having a balanced view. You need to understand what EBITDA is showing you, but it's just as critical to understand what it's hiding.
So here's a simple way to think about it. Use EBITDA as a lens to see the raw power and efficiency of a company's main operations, but always remember what that lens doesn't show you, the very real costs of debt, taxes, and reinvesting in the business to keep it going.
So, I'll just leave you with this final thought. The next time you're looking at a company and you see that big, flashy EBITDA number, what's the very next financial metric you're going to look for to get the real, complete story of that company's health?